Hey everyone, welcome back to Corporate Decoder. Today, Virtu Financial Inc. VIRT just filed an amendment to their credit agreement, and I'm seeing a significant jump in their debt. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just took on a massive new loan, and we'll break down what that practically means for their finances and future. Alright, let's dive into this filing from Virtu Financial. The main event here is an amendment to their existing credit agreement, and it is pretty hefty. They've officially amended their credit agreement for the fourth time, and this one is all about adding new debt. So, on the 23rd of July of 2026, Virtu Financial LLC, along with some of its subsidiaries, entered into what they're calling Amendment Number 4. This amendment changes their credit agreement that was originally put in place back in January 2022. What is really happening here is that Virtu is issuing new loans. Specifically, they are adding $500 million in what are called incremental senior secured first lien term B-2 loans. Think of this as taking out a big new loan that is secured by company assets and has a high priority if things go south. This $500 million addition pushes their total balance on these specific term B-2 loans up to over $2 billion, sitting at $2,029.55 million to be exact. That is a massive amount of debt. The company says this money is for general corporate purposes, which basically means they can use it for whatever they need to run the business. Now, let's talk about the cost of all this borrowing. These new loans, along with the existing ones, have interest rates that can be chosen by the company. They can opt for a rate based on the prime rate plus a margin, or a rate based on SOFR, which is a benchmark interest rate. In either case, there is a spread on top of these benchmarks. For example, one option is the prime rate plus 1.50% and another is SOFR plus 2.50%. These are not trivial interest costs, especially when dealing with billions of dollars. If we look at the total loan balance of over $2 billion, even a 2.50% interest rate means they're paying over $50 million a year just in interest. These loans aren't short term, they are set to mature on the 21st of June 2031. This means Virtu has to pay back the entire principal amount on that date. That is about 5 years from now. While the bulk of the payment is due at maturity, there is also something called amortization. This means they'll be making small payments towards the principal each year. For these new loans, it is about 1.0% of the amount borrowed paid annually. So they're chipping away at the debt, but the vast majority is still due in 2031. On top of the regular payments, they also have these contingent principal payments. This usually means if the company generates a lot of extra cash, or if certain other positive events happen, they might have to pay down more of the debt. It is a way for lenders to ensure they get some of their money back faster if the company is doing exceptionally well. Okay, so that is the core of the filing. They've taken on $500 million in new debt, pushing their total term loan balance to over $2 billion, with a maturity in 2031. The filing attaches this fourth amendment as Exhibit 10.1. This document would contain all the nitty-gritty details of the loan terms, covenants, and guarantees from JP Morgan Chase Bank, who is acting as the administrative and collateral agent. They also included a press release from the 23rd of July as Exhibit 99.1, which is what companies typically put out to announce significant events like this. This is where they try to frame the borrowing in the best possible light. The report is signed by Justin Waldie, Senior Vice President, Secretary, and General Counsel. This tells us that the legal aspects of this massive debt issuance have been handled and approved at a high level within the company. Now, looking at this from a broader perspective, Virtu Financial is clearly leveraging its credit facilities to potentially fund growth or manage its operations. Taking on $500 million in new debt is a significant move. We can see from recent news that their total debt is now reported to be around $2.03 billion, which aligns with this filing. From a financial health standpoint, a debt load of over $2 billion is substantial for a company with a market cap around $12.8 billion, as indicated by the research context. While Virtu operates in the capital markets, which often involves leverage, we need to consider if this new debt creates an undue burden. The interest payments alone will be a considerable ongoing cost. The fact that they have a total term B-2 loan balance of over $2 billion and are taking on more debt suggests a reliance on borrowed funds. We need to ask if this additional leverage is a strategic move to capture new opportunities or a sign of potential strain or a need to refinance existing obligations. The maturity date of 2031 means they have some time, but it is not an infinitely long runway. Managing this debt will be a key focus for the company's financial management over the next several years. The mention of contingent payments based on excess cash flow is standard practice and a positive sign that lenders want to be repaid quickly if profitable conditions arise. From a Warren Buffett style of analysis, we'd look at how this debt impacts the company's intrinsic value and its ability to generate free cash flow. A heavier debt load typically increases financial risk. For Virtu, this means that any downturn in their business could have a more magnified negative impact due to the fixed interest obligations. What I am seeing here is a company that is actively using debt to finance its operations. The key question for investors will be the return on investment for this borrowed capital. Are they using this $500 million to fuel profitable growth that will far outweigh the interest costs? Or is it simply to maintain existing operations or perhaps address other financial needs? The risk I am watching is the company's ability to service this significant debt load, especially if market conditions become less favorable. What I am actually looking for is the return on investment generated by this new capital. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord in the description.